I mentioned this survey of analysts and fund managers suggesting that we're going to get back to this year's highs for Chinese stocks by the third quarter. They're looking at the CSI 300 at 4,200, the Shanghai Composite at 3,100. As David was mentioning, the Chinex is also looking a little bit frothy, maybe in overbought territory. What are your views? Is there more room to move now for Chinese stocks, given that the virus seems to be relatively under control? And, of course, this phase one trade deal, as the US is saying, is still on track.
Absolutely. Thank you very much, Tom. No, we're very excited about China, and China really is a recovery story this year. Our forecast for China's GDP growth for 2021 is in the high single digits at 8%, which is substantially higher than any other regions, including U.S. Our forecast for U.S. GDP growth at just under 4%. So we're very, very positive. You mentioned about Tencent, especially we're positive in the technology space. So we do think that there is still room to growth, and this is actually a good time for investors to look at the tech space within China.
So where exactly in the tech food chain are you focused at this particular moment?
Sure. We like everything touching upon 5G. We like data centers or even cloud innovation. China is forecasted to be the second fastest growing cloud market in 2021. We like communication services, online streaming platforms, and of course, last but not least, healthcare and consumers-related tech.
Now, Mandy, how does it translate into, I guess, how I view Hong Kong? Because you mentioned tech. Soon enough, we're going to get maybe Alibaba, maybe some others as well, joining Tencent in the index as well. And how does the inclusion of high multiple, high growth companies like those actually move the index? I mean, is buying Hang Seng very simply now a play because of what's about to come?
I mean, we do encourage the investors to look at active managers. So for us, we've been very excited in being able to outperform the market. Our strategy had outperformed market substantially. But if you look at the Hang Seng Index, since the lowest point in March, the Hang Seng Index had added 15% to performance. And this includes, obviously, JD.com's listing, which was very successful, almost 180 times oversubscribed. So there are some big names that are looking to come back to Hong Kong to list out in Hong Kong. And the Hang Seng Index is certainly a good opportunity to tap into those opportunities. But this is also a good opportunity to have to manage volatility through active managers as well.
Okay, just moving things along from equities, I want to talk about credit with you as well, broader credit. Investors are obviously looking for yield. You also have some defaults happening, as always, more so now than ever. What kind of yields can investors now realize without getting too much into that danger zone? Where's the sweet spot in credit?
Sure. When it comes to high-yield investing, there is actually a little sub-asset class called senior secured bonds. And the yield is as high as an unsecured bond at 8%. But the difference between senior secured and unsecured bonds is that these senior secured credits tend to sit quite high up in corporate structure, providing very strong recovery. And we've seen, with very sound restructuring, we've seen recoveries that can be above par. And providing 8% yield with these relatively safer senior secured bonds, these are actually credits that we're very excited about. And we, as investors, tend to want to stay away from high yield because of default rates. We're actually finding this space to be a gem.
Mandy, interesting. How do you read what's happening in the bond space in China then, in terms of offshore, which, as David was saying, we're now looking at records in terms of those defaults, versus onshore, where you've seen that essential protection from the PBOC? Is there a risk that some of the corporate pain is being covered up, that longer term we're going to have to face up to some of the issues that corporates are facing here in China, and that investors could get burnt?
The $4 billion of defaults is a very scary number, but if you actually translate that to default rate, it's give or take about 1% of the U.S. dollar China offshore bond market. Compared to U.S. default rate, which is in the high 3%, or Europeans' high yield default rate at 2.6%, it's still a relatively safer asset class when it comes to high yield investing. Apart from what I mentioned earlier, if investors are really, really looking for strong yield, 8% plus, then the senior secured bond segment is an even more attractive segment. So there would always be risk when you're investing into the high yield market. But from a relatively speaking perspective, given the strong yield that you're getting and the default rate is still at the low single-digit %, it is actually a good asset class that we would encourage clients to look into.
And just your views as well here, Mandy, on the sovereign space. You had the likes of Citi and Standchart out with notes recently, in fact, just this week, saying it's not going to get better up until August because of all the supply coming through. How do I approach the sovereign bond space in China these next 4 weeks?
We actually do like the sovereign bond space, especially investment credit space, not just for China, but literally around the world. I think given what happened in February and March, the liquidity is very, very important. And the investment-grade sovereign debt space is where clients can still get very, very strong liquidity that will also dampen risk and help diversify the portfolio. So when investors invest, we try to encourage them to look at the entire asset allocation of the portfolio. And there should definitely be a spot for safer assets such as investment-grade sovereign debts that can, from a yield perspective, it might only be giving you a lower single-digit yield, but it does dampen a lot of the risk and the volatility that we expect in the investment market these days.